The US stock market continues to bask in the bullish limelight yesterday, where both the S&P 500 and as well as the small cap Russell 2000 rallied to respective all-time closing highs, added by a softer than expected US producer price index that toned down the hawkish pricing in the US Fed Funds futures. Gold retreated close to a minor range resistance that was being made earlier at the start of this week, which is close to a 2-month high due to conflicting macro factors. Number one, the positive side, we start to see the retreat of US producer price index coupled with US CPI that toned down the potential hawkish pricing done by the US Fed Funds futures traders. On the other hand, US-Iran tension does not seem to be subsiding due to the rather fluid situation between the US and Iran situationship, as both of them try to trade butts over the reopening of the Strait of Hormuz that could potentially keep oil prices remains on the support above the $70 US dollar per barrel. And the dollar continues to trade mixed in a sideways fashion in the past 2 sessions. Very good morning to all and happy Friday. Welcome back to today's Daily Dose of Market Insights. Today will be the Friday, the 14th of August 2026. So let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so let's have a quick recap on what has taken shape in the last 2 sessions, given the fact that I was away on a caregiving duty leave yesterday. And before we jump straight into the technical analysis focus of the segment for today. So today, I will just highlight a couple of key interesting technical configuration on the intraday basis that, in my opinion, will potentially form a much more significant volatility movement. So let us now take you through the first segment of the daily. All right. So what you could see over here is that let me touch on this Federal Reserve Fed speak yesterday. So there are 2 Federal Reserve spoke yesterday. One of them is Fed Hamid. So Fed Hamid, she's one of the hawkish camps, stating that Fed should rise interest rates in the near term to restrain growth and inflation. And the other Federal Reserve official, pardon me, is Fed Barking. So Fed Barking, he seems to be having a much more open-minded, we call it a stance over here, saying that, give me a minute, yeah. It's still not clear that the US Federal Reserve will have to rise rates to restore inflation to that central bank desired long-term 2% target over here. So one of the reasons why he's kind of hesitant to be on the hawkish camp is due to that sluggish non-farm payroll data that was released last, where it actually declined to a negative print over here. And what we have is that we know that US CPI data previously came within expectation. The second tier inflation trend data, which is the PPI data, which is take this data as a cost of doing businesses in general for the US corporation in the US. All right. So I think it's a bit lagging on my end. Give me a couple of seconds to fix this. Not sure why is it so slow over my computer. So I hope you guys are able to see the screen. Okay, I think it's lagging. Not sure why. Okay, good. So it's back again. So what you see that the core PPI month-on-month for July, that means stripping out of those volatile items, came in below expectation. All right. So market is expecting 0.3% month-on-month and came in softer at 0.2%. And if you look at the annualized one year-on-year, it came in within expectation. So with this dip expectation as 4.2% year-on-year, in line with 4.2% year-on-year in July, but it also dipped below the previous month of 4.7%. So if you look at the one that is stripping out all those seasonality factors, because month-on-month we do have some kind of seasonality factors in play. So if you strip off the core PPI strip off this, pardon me, this seasonality sector by looking at the year-on-year print, we start to see a gentle downdrift from its high. Come on, high that was printed on 4.9% year on year in April. So right now it dipped down to 4.2% year on year in July. So that actually is an encouraging sign stating that despite this ongoing elevated oil prices, it hasn't really crept back into the real economy yet, the real US economy yet, by looking at the downdrift in the core PPI year on year, and as well as the core CPI year on year that was released in the previous day. So that allows the repricing of the hawkishness that is being seen in the Fed funds futures trader, where initially they have a high odds of looking for a US Federal Reserve hike to come as soon as next month, which is the 16th of September FOMC meeting. And after yesterday's softer US PPI print, US PPI print, that probability has toned down significantly to below 50%. So Fed funds futures traders now is not expecting any rate hike to come as soon as September, and instead this rate hike is being priced out as later in the December meeting. So previously, before the release of the PPI, which I went for my break, we still see about 70% chance that the market is looking for the first hike to come in as in October meeting, the 28th of October 2026 meeting. But that has been reduced to almost a coin flip as well, 58%. And right now, only the higher odds is being pushed. We call it push backwards towards the December meeting, which is the last meeting of this year, 9th of December 2026, at around 89.90% chance, which is, to be precise, 89.93. And if you look down the calendar, previously there's a second interest rate hike that is coming in as soon as the first quarter of next year. So the second interest rate hike has also been evaporated as well, because by the 17th of March 2027 FOMC meeting, previously about 71% chance, and that 71% chance evaporated, where market is now not looking for a second interest rate hike by the first quarter of next year. So market is looking for it to stand pat all the way until the end of next year. That means market is now only looking, the market which I'm talking about, the Fed funds futures market, is now only looking for a one interest rate hike after yesterday softer than expected PPI print, and due to the mixed messaging coming out from the two Federal Reserve officials, which I highlighted yesterday. So that actually causes the US dollar to yo-yo. So if you look at the US dollar, we call it 5-day rolling performance against the other major currency, it starts to trade in this wild sideways configuration. So this is the 5-day rolling performance of the US dollar against other major currency as of 14th of August 2026, which is right now, right here, right now. And if you look at the 1-day rolling performance, which is taking into account the last 24 hours, very clearly it also starts to trade in a very sideways rangy configuration, where the dollar underperformed against the Kiwi right now by down by negative 0.22%. All right, so unless with the outlier, which is the Kiwi. All right, so if you look at the US dollar index, for sure it continues to track between this previous major range, we call it resistance, that got previously broken out on the first chair Kelvin Walsh, we call it FOMC meeting, where he took over as officially as a kind of a fresh new chairman, where he him his first FOMC meeting, that is on the 18th of June. Then thereafter, the dollar strength got tempered off and reintegrate back below the 20-day and the 50-day moving average, and so reintegrate back below the all-important zone of 100.54/100.10, which was the previous major range resistance, indicating that that previous breakout over here is considered as a bull trap, or it's a failure bullish breakout. And thereafter, prices can't break below the key 200-day moving average, which is at 99.26, after it printed a low of 99.42 on this on 3rd of August, right? That was last Monday. So thereafter, since for the past 8 sessions or so, or around 2 weeks, it starts to trade between this sideways range between 99.27 and 100.10/100.54. So more of like a sideways range movement, as we are being impacting this cost and pull impact on the global markets. Because right now we know that PPI and CPI data tends to be backward looking, they're not forward looking. But what if oil prices in the next 1 month starts to spike up back again to $80 to $90 per barrel and even $100 per barrel due to this very fluid situation in the Middle East, where both US and Iran doesn't seem to be coming to a middle ground to agree to that reopening of the Strait of Hormuz. So if tension re-escalate again, potentially we're talking about around the September, the November, or even the October CPI print may start to go back up again due to the fact that PPI and CPI data tends to be more backward looking. So that actually causes the FX market participants to be trapped inside this sideways range as they navigate this kind of conflicting macro fronts over here. So if you look at the situation between US and Iran right now, so this is a news flow coming out from Trump's apparently he tries to pivot to using economic squeeze. That means instead of very harsh military attacks on Iran's targeted infrastructure, he decided to squeeze Iran used to by economic warfare. That means by rushing up the sanctions against Iran, stripping off their what I call it their cash flow, and as well as igniting blockage along the coast of Strait of Hormuz, preventing Iranians oil shipments to flow to the rest of the world. So basically, the US military campaign against Iran has failed to force the regime to capitulate. So Trump administration is relying on economic sanction and a naval blockage to stifle Iran oil export. So they decided to actually bleed them until Iran decided to throw in the towel and agree to US terms of whatever so-called interim peace deal, and thereafter of reopening the Strait of Hormuz. So instead of doing a rather last 3 to 4 weeks where they do that targeted military offensive against Iran, that doesn't work. So Trump administration is now looking to open up another war front, which is doing the economic sanctions over here. So US is betting that suffocating economic pressure, dubbed maximum pressure, will lead to the collapse of the Iranian regime. Then potentially there will be a new leadership renewal in Iran that could adhere to US demands on that interim peace deal, then potentially leading to a finalized peace deal, which takes into account of the dismantling of Iran's nuclear program. So until that takes place, potentially things are very fluid between US and Iran. If tension re-escalate again from either one of the side, that could actually bring oil prices back up towards the $80 to $90 per barrel front, or even $100 per barrel. That actually explains the reason why the FX market is being trapped in the sideways range. That means why the US dollar is trading pretty much in the sideways range. Yesterday, we also have another news flow. This is more pertaining to Hontis. So we know that the Hontis is one of the long-term, we call it a friendly country towards Iran or their allies. So Hontis will tend to actually assist Iran in doing targeted attacks on US airlines in the Middle East. So what they did over here is that Hontis hit Aramco, Janzi refinery for the second time in the week. All right, so basically trying to disrupt oil supply flowing out from the Middle East in a nutshell. So potentially elevating higher cost of living for US airline and eventually US itself. So as I mentioned, things are very, very fluid right now. We don't know how this situation will end. That means, i.e., oil prices could still spike up at this juncture. And the next thing is more pretty much concerned about the dollar yen side of the story. So we know that dollar yen previously in the last 2.5 weeks, we see a dramatic decline in the dollar yen due to that historical joint FX intervention between US and Japan. But after that joint intervention takes shape, where the dollar yen hit a low about 155 level, and it gradually moved all the way up towards 159/160 handle, where this is the level that causes the joint US Japan intervention to took shape. So what's interesting over here is that yesterday there's this news flow coming out from Bloomberg. Despite this joint intervention that has taken shape earlier 2 weeks ago, failed to cause the dollar yen to go down lower. Instead, the dollar yen pushed back up, where speculators are now trying to test the resolve of the previous significant intervention episode to see whether both sides of the government, the US and Japan has the resolve to go against this speculative move where they believe that the dollar yen should strengthen further from here due to potential deterioration of the Japanese budget deficit due to the fact that the current administration, which is the Japanese administration, wants to embark on a kind of a expansionary fiscal policy. So what's interesting over here is that we know that previously the Japanese government under the new PM, she wanted to have a much more put it away, less tighter monetary policy in line with an expansionary fiscal policy to drive up Japanese growth. And yesterday's Bloomberg report saying that, in fact, right now they have decided to switch stance over here, saying that the Prime Minister Sane Takachi government is now supportive of a near-term rate hike by the Bank of Japan, which could come as early as in September or in October over here. So apparently, it seems to us that some key cabinet minister within the current Japanese administration is getting a bit uneasy over the yen weakness that could potentially hurt their voters, the popularity. Because don't forget, if the yen continues to remain weak, potentially it could sip up Japanese consumer confidence over here. So that is a very interesting element to watch, as speculators right now still trying to actually test the resolve of 2 weeks ago joint FX intervention to push down the dollar yen. That means, i.e., pushing out the dollar strength against the Japanese yen. So later I'll share with you the technical chart and one intermarket analysis on how these things could potentially evolve from here. All right. So that covers the first segment of the daily dose. All right. So now let me touch on the second segment, which is the intraday technical outlook segment, which I will highlight several interesting technical analysis configuration that could have a potential significant impact today on the intraday basis. Right, so let me expand my screen. So it seems to me that things are getting very laggy over my end. Hopefully it doesn't hang. Okay, give me a couple of seconds to fix this. Oh gosh, perhaps it's a Friday where my laptop decided to take a short break. Okay, give me a couple of minutes just to fix this thing up. So I'm not sure why is it so laggy. Okay, it's really very slow over my end. Okay, give me a couple of minutes. Oh gosh. All right, expand the screen. Okay, all is good now. Okay, so let me touch you through the FX market over here, starting with the dollar yen. All right, so this is the chart of the dollar yen. So we know that the dollar yen it traded sideways after punching through 158.55, exposed non-farm payroll data, where previously it dipped down to 157.30. That's our support. Then thereafter it drifted back upwards again, where what I mean that the speculators in the FX market is testing the resolve of the Japanese government that trying, and even the US government that trying to elevate the yen weakness. That means to prevent the dollar yen from going up higher. And right now it's floating exactly at this area here, where previously we see a big slide. So this big slide took shape on 31st of July, Friday, where we have that historical joint FX intervention by US and Japan that took shape. All right. So what interesting over here is that before I touch on these levels to look out for, I want to share with you one intermarket element, which is very, very, come on, what is this? This is the one. So one intermarket element which has a very strong direct correlation with the movement of the dollar yen from a long-term weekly chart perspective. So the top of this chart over here are the yield spread between the US Treasury yield, both 10-year and 2-year. That means, i.e., we know that the yen is so weak because the US Treasury yield is trading at a premium over the JGB yield. But however, this premium has started to dissipate since 13 or late July or the 27th of July, that was way before the intervention take shape. Right, so this is dollar yen here. So if you look at the one that is very close, that is very more sensitive to monetary policy stances, which is the 2-year Treasury yield spread over the 2-year JGB yield spread. So after hitting a level at 2.74%, the yield spread, which is on 27th of July, it started to drift downwards towards 2.51% as of now we are speaking. So indicating that the yield premium where the 2-year US Treasury has previously over the 2-year JGB yield has started to shrink or narrow. So that could potentially assist the yen weakness to get halted. That means the dollar yen should actually goes down from here instead of going up. So we have a macro factor, a long-term macro factor that is supporting a potential U-turn in the dollar yen based on this intermarket correlation that I shared with you guys. So hence with that, if we go back to the intraday chart of the dollar yen over here, the previous push up, all right, below the 15945 level. So this 15945 slash 15950 previously was our neutrality stance that I have. Right, if you those who recall my daily dose previously, I have a neutrality stance between 15950 and 15855. So 15950, 15945, it didn't actually surpass yesterday. It just touched a bit, then it drift downwards. But what's interesting over here is that its hourly RSI continues to print a series of lower high. Right after that bearish divergence that takes shape on the 11th of August, it's going to print a lower high. So indicating also the lack of upside momentum in the shorter term time period, coupled with a longer term macro factor, which is the 2-year US Treasury yield spread over the 2-year JGB yield. The US Treasury 2-year premium has started to shrink against the 2-year JGB yield. That could also be potentially supportive of dollar yen weakness. So with that, for today, this is the potential highlight I want to highlight over here for the dollar yen, given the fact that it's can't break above a key inflection level, coupled with bearish elements seen on the hourly chart and as well as the intermarket analysis chart that is supporting dollar yen weakness, which I flashed out earlier. So hence using 15950 short-term pivotal resistance for the dollar yen, potentially it may drift downward lower to retest the neutrality zone, the lower limit 158.55. That will be my intermediate support for today. Breaking below it exposes 157.95 and even 157.30, which is the minor swing low due to that sell-off that take shape ex-post Northern payroll on last Friday, 7th of August. Only a squeeze back up and hourly close above 159.50 will increase the odds of it squeezing upwards towards the level where it triggered the US Japan joint FX intervention, which is the 160.75 level. All right, so that's the highlight for the dollar yen. Next up will be the global stock indices over here. So the global stock indices, one indices on the highlight will be the Nikkei 225. So still recall that the Japan 225 or represent Nikkei 225 did that bullish breakout expected, where previously we are anticipating a bullish breakout on Wednesday, where it actually did a bullish breakout above 67.54, which is also the 50-day moving average, drifted upwards as expected, hit our intention resistance level, which is the upper limit of this minor ascending channel at 68.813 over here. So more or less the up move has already been met on a very shorter time scale. We know that price action don't go up vertically, it oscillates within a minor or medium term uptrend phase. So this minor uptrend phase still remains intact over here as price action now trades above the 50 and the 20-day moving average, except the fact that it hit a minor exhaustion point where the bulls may now take a breather on a intraday time frame basis. So hence on an intraday time frame, I will now flip to a bearish bias for a potential minor mean reversion to revert it back towards the lower limit of this minor ascending channel that has been in play since 29th of July, supported by a bearish divergence that has been seen on the hourly RSI. Hence, using today's Asia session intraday high, 69,635, short-term pivotal resistance level as we are speaking right now, 11:26 a.m. Singapore time, flip to a intraday bearish bias for a minor mean reversion decline within its short and medium term uptrend phase that is still intact. First support level to watch, 67,554, which is the previously minor range resistance, got a bullish breakout, now turns into a critical near-term pullback support level that is also very close to the 50-day moving average. Only breaking below 67,540 may trigger a deeper mean reversion decline to retest the lower limit of this short-term ascending channel support that is coinciding with this graphical minor swing low of 12th of August and 11th of August at 66,736, 66,280. So once price action hit between these two support level, I'll be on the lookout for a bullish reversal candlestick to flip my bias back towards the bullish side of the story again, given that it's short and medium-term uptrend phase remains intact. All right, so that's for the Japan 225. Now, over to the update of the major US stock indices. So the one that hasn't hit a fresh all-time high, which is the US Wall Street 30 together with the Nasdaq, which I'll cover very shortly. So the US Wall Street 30 represents the Dow Jones Industrial Average, continues to do a minor drift downwards. But however, the hourly RSI continues to remain supported by a parallel ascending trend line support, as you could see on the screen over here. And it's now going back up above the 50 level mark, indicating that upside momentum on the very shorter time scales remains intact. So with that, price action still can't clear above our first resistance level that we highlighted before we go for my caregiving break yesterday at 54,284. So with that, still looking for a bullish bias move to retest 54,284, give you a bit of access at the short-term pivotal support level previously highlighted at 53,757. Which is this level over here, taking into account of yesterday's intraday low at 53,641. All right, so 53,757 slash 53,641. All right, so let me repeat. So it is 53,757, 53,641. Medium key short-term pivotal support level. Maintain a intraday bullish look view for it to retest 54,284. Breaking above 54,284 may assault the current all-time high zone area of 54,530, 54,712, 54,770. All right, only a bearish breakdown below 53,641 that will invalidate this potential bullish reversal move and see the minor corrective decline extending further towards the downside to retest the former all-time high area, now turns into a pullback support zone at 53,415, 53,213 over here. Next up will be the SPX. So the SPX did that bullish breakout from this dotted symmetrical triangle range resistance as we expected, hit our 778 figure level, which is the current all-time high, before it traded sideways over here. So hence, so far, we do not see any signs of a bullish exhaustion yet, as price action on the hourly RSI continues to print a higher high, and it's not really that at the extreme overbought level. At yesterday's overbought didn't surpass above the previous overbought of 5th of August. So indicating that the short-term bullish momentum still remain intact, that could allow the SPX 500 to drift higher. So with that, I will now tighten my short-term pivotal support level. So first support level to watch will be the intermediate support, will be right exactly at the pullback support of this symmetrical triangle range. A bullish breakout level now turns into a first pullback support level to watch will be at 76.69. So to prevent any whipsaw, I will have a lower level as my pivotal support zone, pivotal support level for today, which taking into account of yesterday's Wednesday US session low, pardon me, at 77.45. So using an adjusted upward pivotal support level, short-term pivotal support level at 77.45, maintain a intraday bullish outlook on the SPX 500 for it to stage a potential bullish acceleration towards 78.48, followed by 78.94 in the first step, which is the 0.382 Fibonacci extension of this ongoing bullish impulsive up move sequence, taken it from the low of 30th of July this year. Only a bearish breakdown below 74.45 that would invalidate yesterday's bullish break up to see a failure bullish breakout or a bull trap for it to drift back down towards last Friday key non-farm payroll, ex-post non-farm payroll low at 77.07. Only a breakdown below 77.07 will trigger a minor corrective decline to retest the current all-time high, the previous all-time high, pardon me, the previous all-time high of 2nd of June this year at 76.25. All right, so that's for the SPX. Next up will be the Nasdaq. So Nasdaq is another index that has yet to hit its that has yet to make fresh all-time high. So it's still below the previous all-time high area that was printed on 3rd of June. But price action now continues to remain bullishly constructive. So if you look at the hourly RSI, continues to print a higher high, no signs of a bearish divergence, and it continues to be held by this parallel ascending trend line support level, indicating bullish momentum still remains intact on the shorter term time frame, and also managed to squeeze up above this symmetrical triangle range bullish breakout as intended. And with that, I will now have adjusted tighten short-term pivotal support level. First support level towards will be the range breakout resistance, now turns into a pullback support at 29,944. Short-term pivotal support level, I will tighten it up to yesterday US session low area at 29,723. Hence, with a tightened short-term pivotal support at 29,723, maintain a bullish outlook today on the Nasdaq 100, potentially for it to drift upwards towards 30,380, then thereafter followed by the current all-time high area at 30,728, 30,795. Only a bearish breakdown below 29,723 will negate today's bullish tone to see a minor corrective pullback sequence unfolding, drifting down to retest the 50-day moving average that is confluencing with the minor swing low of last Thursday, 6th of August. Yes, last Thursday, 6th of August at 29,205. Only breaking below 29,205 will see a deeper pullback to revisit the 3-day moving average that is confluencing with this former descending trend line resistance drawn from the high of 22nd of June, now confluencing with the 3-day moving average, acting as a similar pullback area or level or pullback support level at 28,870. All right, so that's a wrap for the global stock indices. Now let us focus on the commodities market. So on the commodity market, gold apparently has facing some kind of technical pullback after hitting close to a 2-month high at 44.34. So initially we wanted gold to drift upwards towards 45.04 over here, but so it didn't drift above 45 to test 45.04, which is the 20-day moving average, and instead it drift back down. Today is the second consecutive day of decline. Right now it's declining by negative 0.55% over here. So with that, there could be a potential retracement taking shape to actually cover this very strong push up of a bullish breakout previously on the 5th of August, where it did a bullish breakout from this minor double bottom range configuration, double bottom configuration previously. So with that, for today, I will use 44.34 as my short-term pivotal resistance level, looking out for a potential extension of this ongoing minor corrective decline. Breaking below 43.20 may open up scope towards 42.30, which is right exactly at the 50% retracement of this very steep rally that has taken shape from the low of 29th of July all the way up to the high of 13th of August, which is a 2-month high. So once it hit this 42.30, I'll be on the lookout for a bullish reversal candlestick because it's residing right above our medium-term pivotal support at 41.80, which is coming very close to the rising 20-day moving average as well, to flip my bias back towards the bulls again. But however, instead, price action starts to squeeze all the way back up above 43.34. That would invalidate the extension of this ongoing minor corrective pullback to see it squeezing back up towards the 200-day moving average at 45.04. Breaking above it will expose 45.80, which is the minor swing high area of 25th of May and 1st of June. Right, so that's for gold. So lastly will be the West Texas oil. So the West Texas oil continues to be now trapped or sandwiched between the 20-day moving average and the 50-day moving average due to this very fluid situation between US and Iran, which I mentioned earlier. So with that, I will now have a mixed element that is screaming back at me over here. So despite the fact that it drifted down below the 20-day moving average, the hourly RSI managed to shape a, the hourly RSI managed to shape a bounce after hitting the oversold level. That means printed a higher low, a very clear higher low, indicating there is some form of revival of short-term bullish momentum. So with such conflicting elements, I will flip to a neutrality stance for today. Neutral between the lower limit, which is 79.25, which is the 50-day moving average, and the upper limit will be yesterday's US session high before it drift downwards, which is right exactly at the 20-day intermediate resistance level at 82.65. So neutral between 82.65 and 79.25. Breaking above 82.65 will revive the short-term bullish pressure again on West Texas oil to see a retest on the current minor range top of 11th of August and 12th of August at 84.62. Above it may see a test at this all-important 30th of June level where price action gap down earlier on the 3rd of August due to that build-up of the optimism for that reopening of the Strait of Hormuz that hasn't taken place right now. That is at 86.58. All right, so that's a wrap for all the selected asset classes intraday technical outlook. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today, Friday, the 14th of August? All right. So for Friday, 14th of August, a rather quiet session in the US, in the European session over here. The only thing to focus on when the US session gets underway will be retail sales data at 8:30 p.m. Singapore time. So market will be looking at a year-on-year print at 6.7%. All right. So previously it was 6.7% for July. Trading Economics is forecasting it to dip down slightly to 6%. So if it continues to dip down further, that means going below 6% or even below, heading was still at around the 5% handle level, is 5.8 or 5.9%. That could reduce the hawkish pricing behavior in the Fed Funds futures market. So that could potentially influence the major US dollar pair and as well as the major US stock indices. And after that, we have a tier 1 US economic data coming up, which is the US University of Michigan Consumer Sentiment Flash, we call it a print, which is a preliminary number for the month of August. So market is expecting a slight dip to 54.5 from 55.2 printed previously in July. And market will be focusing on the one of its sub report, which is the 5-year inflation expectation, and as well as the 1-year inflation expectation. So for the 5-year inflation expectation, the previous number is at 3.3%. Trading Economics is expecting it to dip slightly to 3.2%. And the 1-year inflation expectation previously it was 4.2%, and Trading Economics expecting it to dip down to 4.1%. So if there's no big surprise where the inflation expectation of the University of Michigan sub-report doesn't come in line with Trading Economics forecast, or worse still, it starts to go back up above the previous July print, where the 5-year was 3.3%, let's say go up to 3.5, 3.7%, and the 1-year inflation expectation print from 4.2%, it goes all the way up to what, 4.4% to 4.5%. That could allow the inflation, we call it the hawkish bet to revive back in the US Fed Funds futures market. So it could be like a sideways movement again for today. Retail sales weak, but however, inflation expectations starts to push up based on the University of Michigan of consumer report over here. So that will be at 10 p.m. Singapore time today. So with that, that's a wrap for today's Daily Dose. And one thing to look out for will be the situation between US and Iran to prevent any major surprises over the Monday. So do practice proper risk management. So with that, do have a restful and a great weekend. And we shall speak again on next Monday, the 17th of August. Kelvin here, signing off. Thank you.